Good morning, everyone. This is Debbie Goode, and I am your moderator for today. I appreciate you all taking the time to be on our webinar. I know these are crazy times, but again, I appreciate you taking the time to be on the webinar today. Our topic today is indirect rate structure and development for government contractors. And our CRI presenters today presenter today is going to be Shay Wolf. And Shay, would you introduce yourself to the audience, please?
Yes. Hi, this is Shay Wolf, and I want to welcome everyone to our webinar today to learn about indirect rate structure and development. I have 35 years of experience in government contractor environment, with 20 of those years as a Chief Financial Officer for government contractors. And I have worked with DCMA and DCAA and other government audit agencies my entire career. So I have extensive knowledge of what they look for in audits and how to set your business up to be compliant with government regulations. And I'll turn it over to Debbie.
And as I mentioned to you earlier, I am Debbie Goode. I'm your moderator for today. And I am a partner in CRI's Melbourne office. I'm the partner in charge of the office. I have over 35 years of experience working in public accounting, providing both audit and review services for companies, many of which are government contractors. About 10 years ago, I founded the Government Contract Advisory Team, which is a group of professionals that educates and assists government contractors. And you can visit our website, which is at www.mygcat.com. I also have over 20 years of experience working in the government contract arena, including assisting clients with rate calculations, pre-award audits, and ICE preparation. I am a Florida CPA and a diplomat of the American College of Forensic Examiners, and I have a bachelor's degree in accounting from Florida State University, go Noles, and a master's from University of South Florida. I'd like to cover with you very briefly what today's agenda looks like. We're going to cover understanding the indirect costs and rates, the difference between direct versus indirect costs. We're going to explain to you what indirect cost pools are and how the allocation basis works. We're going to talk to you about how to calculate indirect rates and also how to project your indirect rates. And I'd now like to turn it over to Shay to begin the presentation. Before we begin the presentation, however, I do want to ask you all a poll question because it helps us to understand where our listeners are so that we can customize this program a little bit more as we go along. So I am going to launch the first poll question. And the first question is, do you currently have any government contracts? And if so, what type? So 4 choices, firm fixed price, cost plus, time and material, or none of these contracts. And we only want you to select one. So if you have multiple contracts, please select the one that represents the largest base of contracts that you have. And I'm going to give you all a few minutes to answer the poll. And I see responses coming in pretty quickly. About 82% have voted. So if you all could continue voting, and then I'm going to close the poll in a few seconds. All right, waiting on a couple more people. I'm going to go ahead and close the poll now. And I'm going to share with you the results. So very interesting that the majority of our audience, 60%, has firm fixed price contracts. And a lot of the material we have today may not necessarily apply for you, but you will see that if you go in the cost plus environment or time and material, that much of what we're going to talk about will apply. So I'm guessing you might be on the line because you're thinking about doing that. We do have 30% of our audience in time and material, none in cost plus, and then we have 10% who are just trying to learn it, figure it out, and move forward. So we're glad to have you all on the line, and thank you for answering the poll question. It really helps us. Now I'm going to turn it over to Shay.
Hi, again, this is Shay Wolf. So what are indirect rates and how do you get them? That's a question that I'm asked very often because the subject of indirect rates and indirect cost is one of the most complex and high-profile items in managing government contracts and one of the most misunderstood. It's one of the only environments in the business world where the indirect rates are so important to your customer, and actually that your customer has visibility into how you set up your indirect rates and how you charge them for your indirect cost. How a company manages its indirect cost is not only a key to profitability, but it's really high on the list when it comes to government audits. Many companies just starting to do business with the government don't really even understand the concept of indirect rates. Yet this is a subject they are faced with right off the bat. When you get a government contract, one of the first things that you're asked is, what are your indirect rates? How are they determined? How are you going to bill us? Let me see your structures. And so the correct answer to this question is not. My indirect rates are really low because I heard that I need to have low indirect rates to be competitive. A lot of clients that I have, when they first come into the office for assistance, that's what I hear. Well, I heard they had to be low, so I'm trying to keep them low. Or this is what they were at a company I used to work for. Or I just figured these looked good and they really don't matter anyway, right? They're just numbers. Well, that couldn't be farther from the truth. They matter very much. And so when in developing your indirect rates, for starters, you must have proper segregation of direct costs from indirect costs. So to demonstrate this to the government, the contractor should have the following things in place. They should have a chart of accounts developed to properly segregate their direct and indirect costs. And in a few slides forward, we'll see that. They should have controls in place to ensure that direct costs can't be charged as indirect and vice versa, because you have to consistently charge your cost as a direct cost or an indirect cost. You can't say on one contract a cost is direct and on another contract it's indirect. You need to have a policy defining the characteristics of a direct cost and an indirect cost, and it needs to be clear on the definitions. And once defined, you must consistently code the cost as direct and indirect. And I'll turn this to Debbie for a poll question.
Thank you, Shay. Okay, our next poll question, I'm going to launch it right now. Has your accounting system been audited by the government before? Please answer yes or no. And we're going to give you a couple more minutes to finish answering. And going to close the poll now and share the results. All right, so this is interesting. We have almost a split, but 58% of our listeners have gone through an audit by the government, and 42% have not. So for those of you that have gone through an audit, I'm sure that you could share your experiences, that it is a pretty intense process and you have to be ready for it. And for those that have not, I'm sure that some of the information we're going to continue to give you today will help you to get ready for that. So I'm going to turn it back over to Shay.
So now we're going to talk about the difference between a direct cost and an indirect cost. So the textbook definition in the Federal Acquisition Regulations for direct cost and indirect costs are shown here. A direct cost is a cost that's identifiable to one and only one cost objective and is normally required or necessary for contract performance. So think of a direct cost as a cost that's used up in performance of the contract. and only that contract. An indirect cost is all costs that are not identifiable or incurred for the benefit of one cost objective, and an indirect cost can be allocated to two or more final cost objectives. So an indirect cost would be a cost that would be shared amongst all of your contracts. Take, for example, a program management. You might want to have one program manager to manage 5 contracts. So that program manager's time would be allocated across those 5 contracts on a pro rata basis. So we're going to just look at a couple of examples of a direct cost here. Cost for labor for employees directly related to contract performance. The cost of travel incurred by direct employees while performing contract efforts. Professional services that are directly related to contract performance. Subcontractor and consultant costs directly related to contract performance, materials and supplies that are used to perform contract efforts, and there might be some other incidental direct costs that are directly associated with contract performance as well. So examples of an indirect cost is company and executive management, accounting, human resources, clerical salaries and wages, fringe benefits such as retirement plan contributions, group health insurance, paid leave, travel and per diem costs that are associated with indirect labor efforts. And what that means is if you have an individual who normally charges to an indirect charge code, such as executive management, accounting personnel, HR personnel, if they travel, their travel is also an indirect cost. Bid and proposal costs and research and development costs are always indirect. Payroll taxes, unemployment insurance and workers' comp. Your IT infrastructure, such as internet, phone, office supplies, postage. Rent and facilities costs, accounting, legal, and other professional fees, and general liability and other corporate type insurances. So this is a sampling of what kind of costs might be indirect. Based on how your company is set up and what industry you're in, you may have more or less of these types of costs. So Debbie, we'll turn it back over to you for a poll question.
Okay, thank you, Shay. I'm going to launch our third poll question now. Do you currently segregate in your accounting system your direct and indirect costs? Yes or no? Okay, I'm going to give a few more minutes to finish up the question. And I'm going to close the poll and share the results. Wow, this is great. 93% of our audience already segregates their direct and indirect costs. That's awesome. I can tell that you guys have definitely been working in the government contract arena, because a lot of times Shay and I see where this is not occurring, especially with companies that have the fixed price contract. So good job on that, and we'll keep going and share some more information with you.
So now we've cleared up the basic difference between a direct cost and an indirect cost, which is the easy part. We can look at the complexities of developing your indirect cost structure. So, based on that poll question, the majority of the attendees here already segregate their direct and indirect costs. And, as Debbie said, that's really great, because a lot of clients that we start out working with, that's a number one problem for them, because they haven't been segregating their costs. And frankly, they don't usually even understand what they're supposed to segregate. So your indirect structures may vary between companies, and very often the type of business a company engages in will drive your indirect cost structure. A large business can have multiple indirect cost pools, while a small business may only have 2 or 3 indirect. So after you define which costs are direct and indirect and set them up in your accounting system, the contractor must then accumulate their indirect costs in logical groupings of accounts that have a similar relationship to the base being managed. DCA calls this homogeneous groupings. You'll hear that word a lot from DCAA. So to be compliant, the indirect cost pools must be allocated using allocation bases that are equitable. This means the indirect cost pools and bases have a causal beneficial relationship. And that's another phrase that you'll hear from DCAA a lot in regard to setting up your direct and indirect cost pools, that there must have a causal beneficial relationship. A good example would be the allocation base for fringes is labor. So this does represent a beneficial relationship, as fringes are a benefit to employees. And if you did not have employee labor, you would not need fringe benefits. So looking at a sample chart of accounts, this is how I generally recommend that a contractor set up their chart of accounts to, show the government that they're properly segregating their direct and indirect costs in their accounting system. And the government doesn't really care about your balance sheet accounts. They don't care about your assets, liabilities, equity, retained earnings, and they don't really care about your revenue. They're interested in the cost. So how you segregate your direct costs from your indirect costs, and then drilling down how you segregate each of your indirect cost pools is what's important to them. So if you set up your chart of accounts with a numbering scenario similar to this, they can tell at a glance, hey, they're segregating their costs properly on the surface anyway. So the typical structure for a government contractor is to have 3 indirect cost pools, which would normally be a fringe cost, an overhead cost, and a general and administrative cost. Some businesses can get by with just having a fringe and G&A. Fringe is really easy to identify. However, it can be really difficult for a small company to separate the cost between overhead and G&A. The indirect cost structure for your business depends on your business model, processes, the size of your business, if you're spread out geographically, if you do diverse functionality within your business, like if you do services and production, that type of thing, you might have more and varied indirect cost structure.
So I just want to add on this, Shay, before you move on, that the structure that we're talking about, that Shay's talking about, can be set up even in a simple program like QuickBooks. We do it all the time and work with our clients on that. So you can set up this structure in QuickBooks and make it operate and work to be able to calculate your rates.
All right, thank you, Debbie. So this chart here just shows you quickly at a glance the indirect cost pools and the types of pools in each cost. So if you had a fringe benefits cost pool, of course, that's going to be the employee-related cost, and your paid fringe benefits, paid leave, those type of things. Your overhead cost pool would have costs that are indirect support costs incurred to support direct operations or direct production. So it would be costs directly related to projects that cannot be identified to one project or contract, so therefore the cost would be allocated to multiple projects. And again, using the example of project management, you might have one project manager that manages 5 projects or 10 projects, and his time would be split on a pro rata basis or allocated on a pro rata basis between all the jobs. Same thing with equipment, facilities, maybe company vehicles that are there to support all of your work. And you wouldn't need those type of costs if you did not have the direct jobs. So that would be what you would put in your overhead pool. General and administrative is the cost of running the business as a whole. They're not identifiable to a project, contract, or product. They're not identifiable to operations or production, and typically would include executive management, accounting, finance, IT, human resources, business development, bid and proposal, R&D, which all those costs are costs that you need to run your company. So if your company was just starting out, you would have G&A costs where you might not even have any direct costs, fringe benefits, or overhead. You would still have G&A costs because you're getting your company started and getting it up and running. And so this chart, we're going to talk about the allocation basis for the cost pools. So we've already talked about what would be in the fringe benefit cost pool. So the allocation base for that pool would be direct labor, overhead labor, and G&A labor, because it would benefit those items. The labor overhead cost pool, the allocation base would be direct labor and fringe benefits applied to direct labor. So general administrative can be a little more complex. The most common type of pool is called, allocation base is called total cost input. And so all costs that are not G&A and not unallowable are part of the G&A base. It's the simplest of the G&A bases, and usually, but not always, accepted by government auditors without any real question. There's also another type of G&A allocation base that isn't used as widespread as total cost input, and it's primarily used by companies that are in manufacturing or that have a high concentration of subcontract costs, and it's called a value-added G&A base. And in this type of base, the material costs and subcontract costs are excluded from the allocation of G&A base. Such costs may not be subject to allocation of other kinds of costs. So many firms that use a value-added G&A base collect the cost of purchasing, processing, and administering materials and subcontract purchase in a so-called material handling or material and subcontractor pool, often referred to as M&H pools or M&S pools. The costs are collected in such pools are applied to materials and subcontracts in lieu of G&A. So what that means is, I know a lot of government contractors, and possibly some of you, when you bid a government contract, you're actually using a total cost input G&A base. But to be competitive, you'll tell the government, okay, I'll apply a percentage to my material and subs that's less than my G&A percentage. And that's actually called an abated G&A rate. But on larger companies, they actually set up a pool, and they actually have a defined material handling rate aside from their G&A rate. So this chart shows an example of logical and consistent methods for allocation of indirect costs to intermediate and final cost objectives to develop your indirect rates. So again, we have fringe pool, and the allocation base for fringe is total employee labor, and the calculation would be you total up the cost for the fringe pool, and you divide that into the total cost of the base, the allocation base, and that gives you your rate. Overhead, again, the allocation base is direct labor and direct labor fringes. You take the total overhead expenses pool, divide it into the total base. G&A, total cost input. You divide the total G&A expense pool into the total G&A allocation base to get your rate. Now we're going to talk about indirect rate calculations. So this is an example of a fringe rate calculation. So this example shows what would be typically in the pool components. Your company may have more fringe benefits than this, less fringe benefits, but these are some typical ones. And notice that the chart of accounts numbers are in the 6,000 series. So again, you can tell at a glance, so 6,000, that's fringe benefits. And so again, you would add your total pool components, and you would add your total base components, divide the pool into the base, and voila, you now have a fringe benefit rate of 30%. So indirect rates are real numbers based on factual data. They're not something that you can make up or get from someone else. It's your company's data. Overhead calculation, along the same lines, you pull your pool components together, you get a total. You pull your base components together, you get a total. Divide the pool into the base, and you have a overhead rate of 26%. G&A, and this, of course, is based on total cost input. Again, the pool components, 8,000 series, then your base components of all direct costs, fringe benefits allocated to direct labor, and all of your overhead expense. So your base component, again, for G&A is all the cost in the company that is not G&A. so total cost input, and you come up with a rate of 20%. And these charts are good to keep on hand to, help you understand the exact calculation and to help you, visually see how this works. Turn it over to Debbie for another question.
Okay, thanks, Shay. And before I get to the poll question, I just wanted to add, it's just really important that you do these rate calculations and get them correct. We're going to talk later about how to project the calculations, but it's really important that you put them in your proposal, that you know what those rates are, because if you get in a pre-award audit situation, which they normally will do before they award a contract on any kind of cost plus or even in a time and material contract, then you could lose that contract if you don't have these rates calculated correctly. So I'm going to go forward and launch the next poll. This is the last poll question. Are you familiar with the term wrap rate? Yes or no? Okay, a couple more minutes. And I'm going to close the poll, and I'm sharing the results. And, this is really good kind of for us because Shay's going to talk about wrap rate next. And some of you may know what it is but aren't familiar with the term, because we have 91% that are not familiar with it. And this is a very important term that you want to know and understand as you're putting your proposals together, especially. So I'm going to turn it back over to you, Shay.
Thank you, Debbie. All right, so it looks like a lot of our attendees don't know what a wrap rate is, or just not familiar with the term wrap rate, and actually know it maybe as a fully burdened labor rate build. You will hear this term a lot in the government contractor environment. Your government customer may ask you, hey, what's your wrap rate? And if you are looking at bidding a job with a large business prime and you're a small business, that's about the first thing they'll ask you, hey, what is your wrap rate? Because this tells your customer how much you're going to add on to the labor cost that you're going to bill them. And so this is a very simple chart that shows you how to calculate your rep rate. So let's just take the engineer as an example. And the base hourly rate for the engineer is $25 an hour. That's what you're going to pay him. You're going to pay him $25 an hour. And so as we went through the calculation for the fringe overhead and G&A, we got a fringe rate of 30%. So in step 2, we're going to take that base hourly rate and we're going to multiply it times the fringe rate, and we're going to get the cost of fringes for that individual. On step 3, we are going to take the base hourly rate, add the fringes to that, and then we are going to multiply that times the overhead rate to get the cost of overhead applicable to that 1 hour of engineering time. Step 4, we're going to add the base rate, the fringe dollars, the overhead dollars, and we're going to apply the 20% G&A to that total to get the total G&A that would be applicable for that base hourly rate of an engineer. Step 5, we subtotal that cost. Step 6, we add fee to that subtotal. And step 7 will give us our total burden rate, including fee. So what that means is for every hour that that engineer works and you pay him $25 an hour, you're going to collect $51.60 from your customer to cover the cost of your fringe, your overhead, and your G&A and your fee. So in this scenario, number 8 shows you your wrap rate is 2.06. So if someone comes up to you and says, hey, what's your wrap rate? You can tell them my wrap rate's 2.06. And then section 9 shows the wrap rate without the fee, which often they'll ask you, what's your wrap rate without fee? It's 1.96. Now, I get asked very frequently by my clients, what's a good wrap rate? I was told by my prime that my wrap rate needs to be no more than 1.5, or my wrap rate, has to be south of 1.6 or something like that. So there is no exact wrap rate. There is no magic wrap rate to be competitive. It depends on the type of contract you're bidding, what type of services there is, But the takeaway here is your wrap rate is a real number. It's not just something that you fabricate or, just make up. It is a real number, and it's based on your direct cost and your indirect cost applied, so that you are collecting all of your indirect costs for every hour of direct labor. And this is a great chart to keep. So now we're going to talk about indirect rate projections. I get asked this question often by clients. Well, how do I project my indirect rates? If I have a contract I'm bidding and it's a 5-year contract, how do I do that? So to forecast your indirect rates, they need to be based on historic cost and projected cost data. If projecting indirect rates will be used in a proposal, the current proposed cost data should be used to determine the projected allocation base to be used in the indirect rate calculation, and I'm going to show you that in just a minute. If award of a new contract would require additional expenses in any of the indirect expense pools, those costs also should be projected and included in the indirect rate calculation for the proposal. So if you are bidding a new job, this form right here is included in many solicitations that I've seen over the years. And the government in the solicitation might tell you, I want to see your last 3 years of actual indirect rates, and I want to see your forecast indirect rates for the 5 years for the life of the contract. So we would start here, say you've only been in business 1 year. So we're going to say the prior year, these are our actuals, and these are the same numbers that we used to calculate our fringe rate on previous slide. So you would start with your actuals, and then based on how you're bidding this contract, you would take the numbers that are in your contract bid to develop your forecast for your future indirect rates. Fringe benefits don't often change because there's such a direct correlation between the direct labor and the fringe benefits that the fringe benefits percent very often will be the same no matter how much contracts you win or lose or anything like that, because it's a direct correlation. Overhead, on the other hand, very often will decrease as you get new contracts. And that's because your overhead costs don't increase usually at the same rate as your direct costs when you win a new contract. So in this example, again, we're showing the prior year cost, which are the actuals, and our rate of 26% that we calculated earlier. And so for forecast for year 1 of the new contract, we are going to look at an increase in some of our overhead costs, primarily in your salaries and wages, because you're going to need additional personnel to manage the new jobs. You're going to have to go rent a new facility, so that's going to be an added expense. You're going to have to go out and buy a company auto. You're going to have more business meetings. You're going to experience more travel because you want a contract in a different geographic location. So we're looking at a significant increase in our overhead costs on the first year of this contract. And to look at the new allocation base, we take our current allocation base, and then we add to it the new contract, which we're estimating at $800,000, and we get a new allocation base. And now when we calculate our overhead rate, now it's down to 22%. And so under year 2, we're going to not only project winning the contract that we're bidding and turning this form in for, we're also going to say that we won another big contract. And so again, we're going to add some additional costs to our overhead expense pool to manage the new work. We're going to add additional direct costs to our allocation base, and now we're going to calculate our overhead rate, and it's going to be 13. And so in this model, we're going to say, okay, that's all we're going to do for the next 3 years. We're just going to win this contract and a couple of other contracts, and our rate's going to be steady for the next 3 years. So when you're working on your pricing for your proposal, you show the government how you forecast your rates, and you use the forecasted rates when calculating your costs for your proposal, this makes you more competitive as you go forward. And the same with G&A. You're going to look at your actual G&A. You're going to look at your what increases might be needed in the G&A pool. You're going to look at the increase based on the new contract that you just bid. In year one, year two, you're going to look at, okay, we're going to win more contracts. So now you see your G&A rate goes from your current actual of 20% down to 12% by the second year of the contract. And a lot of companies come to me for assistance with proposals, and one of the big things is they tell me, our G&A rate is really high and we're not competitive, and we were told we have to bid our actual G&A rate for this new proposal. And that's not accurate. The government wants you to forecast your indirect rates forward, and they want you to use those rates in the proposal, because in reality, if you win new work, your rates generally do go down. So they want you to use realistic and reasonable numbers when you're forecasting your indirect rates. And so this is a time when, if anyone has a question, that they can go ahead and ask the question.
Yes, please post your questions to the site, and we'll take any questions now at this time while we're waiting for questions to come in. I also want to add to what Shay said. When you're calculating your rates, it's very important that you use the accrual basis of accounting, generally accepted accounting principles. That is the basis of accounting that's required by the federal acquisition regulations. And I often see where clients are trying to use a cash basis or some kind of modified cash basis, and your rates aren't going to come out correctly in that case. Here's a question, Shay. If I put in my proposal certain rates, and then the government does not award me one of those contracts, what do I do? Because I've submitted the rates, but I didn't get all of the contracts that I had anticipated.
Well, you just have to, alter your rates going forward. If you didn't win the contract that you were bidding, that you based your projection on, it's no harm, no foul. You didn't win it, so your rates didn't go down. And if you maybe won that contract but didn't win new contracts in the second year, you're just going to have to adjust your projections and, possibly adjust your cost to get yourself back into a competitive rate.
Okay, great. And another question I've got is, will we be sending the slides out after the presentation? And yes, we will. All the webinar recording and slides will be sent out to everybody that has registered for the session. Okay. I don't see any additional questions at this time. So I want to refer you to some great references here that you can go to. DCAA is a great website. The SF 1408, which is the pre-award audit survey, we have assisted clients with filling that out, and that just deals with getting all your controls in place over accounting so that you can pass that pre-award audit. Also, the FAR Part 31 is an important place because that contains all the regulations that deals with accounting. Look at the DCAA guidebooks. I did have one more question, and I think we have time for another question. Actually, I have two. So, Shay, I'm going to, what is everyone experiencing as the turnaround time for their IDC rate to be approved?
Well, that's kind of hard to say. That you have to, if you bid a contract and the government needs to verify your rate, they will request an audit from DCMA or DCAA. So as a contractor, you can't go and ask to get your rates approved. You have to wait until one of your customers requests this from DCAA. I can't say that there's any good time frame. I know that on incurred cost submittals, that you have to do if you have cost reimbursable contracts. You have to submit at the end of the year your indirect rates and all the backup data for your indirect rates. And those sometimes take 2 and 3 years before the government actually audits them and approves your rates. I don't know if that answered your question. If not, you might want to ask me in a different way.
And yep, I got to thank you on that. So you must have done a good job on that.
Okay.
I know it does vary. I mean, we have some clients that have been waiting for in a pre-award audit situation, and one of them had it turn around very quickly, and the other one took several months, and sometimes it depends on the auditor too. The next question we have are, what are examples of indirect bases besides labor?
So I'm assuming by indirect bases you mean allocation bases. Allocation bases for different indirect rates are different. So for instance, the allocation base for Fringe is labor. The allocation base for overhead is labor, but the allocation base for G&A is all of your costs, all of your direct costs, materials, subcontractors, travel, labor, overhead costs, et cetera. Now, I will also say that many companies may have multiple overhead expense pools and allocation bases. So a company that does a lot of manufacturing, they might have a manufacturing division, and instead of labor being the allocation base for their overhead, the cost of equipment might be the allocation base for their overhead. But in general, the allocation base for overhead is usually labor.
Okay. All right. Thanks, Shay. That's it for the questions. And you can connect with CRI on our social media sites, connect at CRI CPA. And I want to thank Shay for being our presenter today. I think she did a great job of both going over the material and answering the questions. So thank you very much, Shay.
Thank you, Debbie. And we appreciate everybody's attendance here, and you'll get copies of the slides, and our contact information is on this slide, so feel free to reach out if you have any additional questions at a later time, or there's something that we can assist you with. Feel free to reach out to myself or Debbie.
So I want to thank everybody again for joining us today and taking the time out of your schedules. Hopefully the world will get back to sanity again and everything will be well. But again, if Shay and I can help you, please contact us and we'll be glad to reach out to you and assist you. And again, this will be posted on our website also, CRI's website. So thank you all and have a great day.